Okay, so welcome to lesson or objective 2. I hope you've got your notes printed and you've got your calculator and your pencil handy because we're going to jump in and do a bank reconciliation here. So the process of the bank reconciliation or balancing your checkbook involves reconciling the differences between what your bank statement says and what your checkbook balance says. So for a bank statement, we're going to calculate what were the deposits in transit. Those are deposits that we made that hadn't cleared the bank as of bank statement date. Remember, when you make a deposit, it takes, sometimes 24, 48 hours for it to actually deposit into your account. And then outstanding checks. Those are checks that we had written or charges that we had made that had not cleared the bank as of bank statement date. And then for our company records, we need to record any service charges, fees, maybe any electronic deposits. In other words, anything that showed up on the bank statement that we hadn't put in our company records yet, in our books. So some things to keep in mind: an NSF check or insufficient funds check is a check that was written and there was not enough money in the bank account to cover the check. Now, we're assuming that we're not writing bad checks or hot checks, if you will, but sometimes a customer may inadvertently give us a check that the bank later rejects and returns to us. So when we're talking about insufficient funds, we're assuming that a customer has given us a check. We recorded that as a debit to cash and a credit to whatever. And now we have to go back and take that out because it turns out that wasn't really money. So a debit memorandum is a deduction from our account balance. Okay, now I know that debit means increase the checking account, right? But remember, we're looking at this from the bank's perspective. And from the bank's perspective, your checking account is a liability. Okay, your checking account represents how much money they technically owe you. I mean, they don't take your money and put it in a little box with your name on it. They take your money and they spend it. They loan it out to people that are getting mortgage loans and car loans and student loans and things like that. And so they're keeping a record of, hey, this is how much we owe you. Should you show up at the bank and be like, I want all my money. I want all my money back. This is how much they have to give you back. So to them, your checking account is a liability. So when you withdraw money from your checking account, you are reducing their liability, which is why they call it a debit card, because the debits reduce the liability, and why they call it a debit memorandum. When you make a deposit increases the bank's liability, so they're going to call that a credit memorandum. So that's why it's opposite from what we think, because we're thinking of the checking account as an asset, which it is to us, but to the bank, it is a liability. So step-by-step instructions for preparing a bank reconciliation. We're going to go through and prepare a list of all those deposits in transit, those deposits we made that hadn't cleared the bank as of bank statement date. We're going to prepare a list of any outstanding checks that we wrote that hadn't cleared the bank as of bank statement date. We're going to record any bank charges or credits that appeared on the bank statement. So maybe that was an automatic deposit, a bank charge, anything like that that was on the bank statement but not in our books. We're going to calculate the balance per book, so the reconciled balance. We're going to enter that balance on the reconciliation. We'll total the deposits in transit, total the outstanding checks, compute the balance per reconciliation, and then they should equal. If they don't, then we got to go back and figure out what we left off. So let's walk through that process. So if we're comparing our bank statement with our bank records, we're going to see that we had one outstanding check of $580. That was for check number 15. We also see that we had a deposit in transit of our deposits in transit of $900. So here we see we've put our outstanding checks down. We've got our beginning balance on the statement. We've got our deposits in transit that we're adding up. We're going to subtract those outstanding checks, and this gives us our adjusted balance of $39.12. So there was one thing that was on the bank statement that was not in our books, and that was that service charge, that $5 service charge. So we need to now do a journal entry to put that in our books. So we're going to debit service charge expense and credit cash for that $5. Now remember, electronic funds, most of us are using electronic banking as opposed to paper checks now. ATMs, certainly used to ATMs were only a way that you could get, cash out, but now they do a lot more. So as we get more sophisticated with this, we do have to adapt our procedures a little bit.